From theCUBE studios in Palo Alto and Boston, bringing you data-driven insights from theCUBE and ETR. This is Breaking Analysis with Dave Vellante.
Microsoft just delivered what looks on paper like a great quarter with a beat of 1% and 5% on revenue and operating profit respectively. But the two-day reaction from investors tells a different story, with the stock off double digits, around 12% at this hour from its pre-earnings price. Last quarter, increased capital spending was interpreted by investors as a signal for enthusiasm and confidence, but AI ambition has turned into AI skepticism. Specifically, Microsoft's CAPEX came in higher than expected, but Azure growth didn't. And without a clean bridge from capital spending to clear cloud ROI, Azure growth, despite an impressive performance, has become a sticking point. In this breaking analysis, we unpack nuggets from Microsoft's Q2 26 earnings print and explain why, in our view, the street's negative reaction is missing a bigger picture. Ken, if you don't mind bringing up the first slide, please. So what you see here is a 5-day chart of Microsoft's stock, and you can see on Thursday after the close, the stock dropped, and or Wednesday after the close, after the announcement, the stock dropped on Thursday and continued to drop today, although it was mixed. In the upper right corner, you can see Zuckerberg and Satya with a frown on his face. Meta actually killed this quarter, and the reaction from the street was that it's getting value from AI, whereas Microsoft, they felt like it was the reverse. Interestingly, the street was confused because it was down in the morning, and then it was up, as you can see here. This is early morning before the open, and right now is about almost 10 minutes before the close. It's off by about 12% over the last 2 days. And so what I want to do now is unpack some of the nuggets from the earnings call. So Ken, if you bring up the next slide, let's take a look at what Satya said and try to put it into context. So Microsoft Cloud, he didn't say this, but he was doing math, simple math. It's at a $200 billion run rate, which is enormous. And remember, this includes not just Azure, it includes other parts of Microsoft and its SaaS portfolio. But he talked about building token factories, and he also referenced the distributed cloud. And this is something that we've been talking about in theCUBE for quite some time. John Furrier mentions it a lot. The edge is refactoring. He talks about hyperconvergence at the edge, and the importance there is that that's where a lot of the action is going to be. But the fact that Satya's talking about token factories, picking up on Jensen's sort of language, AI factories, producing tokens. So Satya's sort of calling it token factories. But he said the key metric is tokens per watt per dollar. And I just want to sort of take a moment to let that sink in, because as we reported on Breaking Analysis, what Jensen announced at CES this year was a 5x improvement this is with Vera Rubin, a 5x improvement in performance, a 10x improvement in throughput, and 1/10 the cost per token. And we think that's going to drive 15x increase in demand via Jevons paradox. And so we think that, and this is one of our predictions for 2026, is that NVIDIA is going to sort of separate from the pack of GPU players. So if you bring that back up, Ken, Satya talked about their silicon efforts. He talked about Maya and Cobalt and some of the work that they're doing. He talked about AMD, but to us, NVIDIA is the key for a number of reasons. He also talked later in the call, might have been in the Q&A, about examples of how they're improving token per watt per dollar with OpenAI inference. And this is something we've talked about and why we're more sanguine on OpenAI than many of the naysayers, because they have early access, to Vera Rubin. They've got, good supply, or at least better supply than many. So they've got allocation. So that to us signals that NVIDIA is still a key player. And we think this is a theme that you're going to hear not only from Microsoft, but you're going to hear it from Google. You're going to hear it from AWS, who's ostensibly doing a deal with OpenAI. And so we are more encouraged by OpenAI than many people. The other thing Satya said, which is quite interesting, is everything's changing. A new application platform is being born. And this is something else we've talked about on Breaking Analysis, particularly with George Gilbert. When we moved from on-prem software to SaaS, everything changed. The technical model changed, everything went to cloud, the pricing model changed from seat-based to consumption was a big trend. We think that's happening again. As we move from SaaS to AI, we think everything's going to change again. We think the seat-based pricing model is outdated. Consumption models have come into vogue, even despite some of their problems. And we think outcome-based models are going to be increasingly important. Now, what does that mean? Well, we know that there's a goal to get an outcome. We know how many tokens it's going to take to generate that outcome. And so that's how we think the pricing is going to begin to line up, and we'll see how that all shakes out. But the point is that Satya has visibility on how the application stack is changing, and Microsoft is working, vigorously, in our view, to actually refactor that and putting a ton of resources in there. Ken, if you bring that same slide up, one more time. He also talked about agentic. He talked about agentic as macro delegation and micro steering, which is kind of interesting that he talked about it that way. It's sort of, I would say, a little bit of sort of marketing speak, but that's essentially how we should think about it, that agents are going to be orchestrating. There's an orchestration layer, and there are agents that are doing what we've called in the past worker bee jobs, and that's how Microsoft is building this out. All right, let's get into some of the numbers. If you bring up the next slide, Ken, this is kind of an analysis of the CFO's commentary, Amy. So Microsoft has a $325 billion run rate, which is a 15% growth in constant currency. I mean, growing 15% with a $300+ billion company is absolutely astounding. With a 21% growth in earnings in constant currency. AI infrastructure is pressuring margins. So, Microsoft, you think of Microsoft as a software company, their marginal economics at volume, go down to zero. Satya has talked about this, that when you had a CD-ROM, it was the cost of the CD-ROM, which was the incremental cost. And of course, cloud COGS changed that somewhat. As we deliver SaaS through the cloud, you have the COGS of the cloud, the compute, storage, and networking that powers the apps in the cloud. Now, as we move to AI, you've got all these AI infrastructure expenses, GPUs and CPUs, but GPUs, probably 2/3 of the CAPEX are going to GPUs, which is great news for NVIDIA. But so please bring that slide back up and we'll carry on. I think the point is that AI infrastructure pressures margins, and so this is going to come back to a point that we'll make later on, but Microsoft has to balance how much of its allocation for GPUs it puts into Azure versus how much it gives people internally to work on its primary products like Copilot. So we'll come back to that. The third point I want to make on this is that OpenAI is a nuance, but it's recognized, the ownership in OpenAI that Microsoft has is recognized as equity, not profit and loss. So they take the balance sheet data from OpenAI, and that's what they're reporting. So that resulted in a $10 billion gain in GAAP results. So that's just kind of a nuance there. This is the big deal. Microsoft spent $37.5 billion in CAPEX in the quarter. And while that will decrease sequentially, Azure was up 38% in constant currency. I had it at 39%. The street wanted 40%. And it came in lower than people thought. It came in at the guide, but wasn't enough for people. And they're guiding flattish sequential growth rates. The other thing that they said was that had they not had to balance that allocation between Azure and first-party AI, things like Copilot for coding, for for GitHub, et cetera. If they didn't have to balance that with Azure, that they would have had 40% growth in Azure. So kind of interesting commentary, and the street took that as a huge negative. Think about that. Last quarter, the more they wanted to see more CAPEX. Of course, Microsoft Azure surprised to the upside. So people immediately said, okay, those two things are connected. But it kind of makes sense that they're not connected in lockstep. That an investment in AI infrastructure to build applications and build intelligence into applications and provide services via APIs, via OpenAI inference, for example, and other models. Satya made a big deal about model optionality, kind of a playbook out of a play out of AWS's playbook. But if you think about that, it takes time to deliver that infrastructure and translate that into monetization. And people want to see that time frame compressed. They want to see those in lockstep. Okay, let's bring up the next slide and talk about some of the analysts' concern. You've certainly heard this in Q&A and right to the chase. CAPEX growing faster and Azure growing more slowly. And what about the expected ROI? That was Keith Weiss from Morgan went right at that issue with Amy and Satya. So we've now lost that correlation between CAPEX and Azure growth because Microsoft is prioritizing to those first-party apps. And that signals to us actually something that actually makes sense. If you're Microsoft and you know you're going to lower gross margin from Azure, and you get better gross margin from your first-party products, and you're trying to build out those first-party products. And by the way, as we know, Microsoft is kind of shoving Copilot down the throats of its customers, and not everybody's happy. In fact, we've said before on theCUBE that Microsoft Copilot, Glean is what Microsoft Copilot should have been. Well, of course, Microsoft sees that, and this is a classic Microsoft, where the 1.0 product is not great, and then it gets better and better and better as they invest and as they learn. And we think the same thing is happening here. Ken, if you bring that same slide back up. So that's the balance that Microsoft is playing, and we think long-term it's going to pay off. The other criticism or concern was the durability of the backlog. People talked about depreciation cycles for GPUs and CPUs of 6 years, which we wrote about in a recent breaking analysis. But they've got RPO commitments, remaining performance obligation commitments of 2.5 years. That's longer than last quarter, which was 2 years, but still it's a lot less than 6 years. So people were very much concerned about the durability of that backlog. 45% of that, by the way, comprises OpenAI commitments. And so Microsoft kind of dodged that question, I thought, but felt like, hey, we've got good visibility on a big chunk of the backlog, and 25% of that backlog is going to hit in this fiscal year, and that backlog is going to grow, and demand is outstripping supply. And so they were pretty sanguine about that. But the bottom line is Azure growth remains the major sticking point. And so that's something that we're going to have to pay close attention to. Okay, let's bring in some data from our friends at ETR. Ken, if you bring the slide up, this is one of our favorite views. This is for Microsoft. So this is ETR's proprietary net score methodology, which is a measure of spending intention and spending velocity. Let me explain it. These bars go back to January 2023. The lime green, and this is account-based, it's a survey about 1,700 accounts, huge number of Microsoft accounts, well over 1,000. The lime green represents new accounts, the percentage of those in the survey that are new to Microsoft. So it's a relatively small percentage because Microsoft's everywhere. The forest green is those companies in the sample that are spending more than 6% or more on Microsoft platform. This is across their entire portfolio. The gray is plus or minus 5%, so that's flat spending. The pinkish is down 6% or worse. And then the red is churn or defection. If you subtract the reds from the greens, you get the blue line, which is net score, which is hovering, in the mid 40s. Anything over 40% is highly elevated. And so Microsoft, with a $300+ billion run rate business, with spending momentum as defined by ETR of over 40% is astounding and extremely impressive. And it just speaks to Microsoft's ubiquity and frankly, their execution. Now that yellow line up top is an indication of pervasion or penetration into those 1,700 accounts. And you can see it's quite elevated. I mean, we're talking about 70% of the accounts up there. Yeah, a little dip here and there, but that's not something to really worry about. Microsoft is obviously doing very well in terms of account penetration. So this is the key to us. You've got the account footprint. We reported last week, one of our predictions was we saw evidence of stickiness of incumbents, particularly in the database. And of course, Fabric, they mentioned on the call, I didn't mention this in Satya's comments and Amy's comments, but Fabric is one of their fastest growing products in history. And so that's bringing together the data, the analytics, and is something that is, we think, one of our predictions for 2026 is that's going to be more sticky. In other words, if you have the footprint and you have the data, that's has a gravitational pull and will bring in ancillary products, whether it's things like Copilot for Microsoft 365 or for GitHub and other related products that are AI infused. And again, as I said before, the 1.0 and the 2.0 is not always great. Sometimes it's actually less than great, but eventually Microsoft gets it right. We saw that with Power BI. We've seen that with Power Automate. We've seen that with virtually, all products across Microsoft's portfolio. Okay, one more ETR chart, Ken, if we can. This is net score or spending momentum on the vertical axis and overlap in 1,746 accounts on the horizontal axis. And this is the cloud computing sector, not just IaaS and PaaS, it's everything in cloud. And so that's why you see Microsoft in the upper right. I had to circle it because it's, it's so far up there. So you see Microsoft and AWS sort of separating from the pack, although as we pointed out, Google Cloud Platform is catching up. All three of the big three hyperscalers are above that 40% highly elevated line. And then you can see the others, Cloudflare, Salesforce, et cetera, kind of bunched up down there. But, looking at the big three, and we'll show you some data on Oracle as well. You can see sort of Oracle in that mid pack. It's got a pretty good actually pretty good penetration on the horizontal axis just behind Cloudflare and Salesforce. And if you think about it, those two companies, sell products at, much higher volume than Oracle. So Oracle's, high value, high price. So you can see Oracle, IBM's there as well. But back to the big three hyperscalers, we are seeing the cloud outpacing on-prem and continuing to do so. I think Microsoft's hybrid business and their on-prem business grew low single digits, 1% to 2%. Meanwhile, its cloud business, overall cloud business growing in the mid 20s, its Azure business, almost 40% growth. And so we think this scenario is going to continue. We think, the rich get richer. That said, actually, Ken, bring that back up one more time. You can see CoreWeave in the left, way over there on the left, hitting this is enterprises now. Remember, CoreWeave sells to, a lot of companies that are, AI specialists. So you might not expect them to show up in the ETR survey, but they've hit the survey. Their net score is not off the charts, but the fact that they've even hit the survey. So we're watching CoreWeave and Lambda and Crusoe, who builds data centers very closely, as basically powering that AI infrastructure, which ultimately is going to lead to a shift, we think, in IT spending. We said in earlier breaking analyses and on CubePod, on average, IT spending is about 4% of revenue across the board. That's a good assumption, good rule of thumb. We think that over the next 5 to 7 years is going to jump up to around 10% of revenue or more. And we're going to see a shift from the traditional legacy IT to accessing or generating the capability of generating tokens through APIs. So it's going to be token API services that are going to power a new level of productivity within organizations, new workflows, and that's something that we're going to, we think, see in the spending shift. The cloud guys are in a good position there, in our view, despite some of the challenges, we've seen. They continue to grow, quite nicely. We're talking about a very large business. In fact, if you bring up the next slide, we'll take a look at the big four here: AWS, Azure, GCP, Alibaba, and Oracle. This is a view of back to 2020, and you can see how the shifts are occurring in the market. This is just IaaS and PaaS market share, so it doesn't include, Microsoft 365 and, some of the other software products. AWS essentially invented this market, or reinvented it, and you can see the 2025 estimates. Azure is our actual figure. Microsoft doesn't release the absolute Azure number, but we've triangulated, and as you've seen in many breaking analyses. Microsoft does play games, and with I call it play games with its definitions. We've reported on that extensively, but I actually think this Azure definition is cleaner because they've taken out some security licenses and some other end user point products that were designed, I guess, to boost Azure numbers in the past. They took those out as they slowed down, and they replaced it with AI services running on Azure, like OpenAI inference. So you can see Azure is at 87 billion for 2025. A significant increase in its market share. It's growing at 38%. You can see AWS, is still very large, but it's growing at a slower rate. Although we have that rate accelerating this quarter. We'll see, they report, I think, next week. They see Google has made some good progress. The encouraging thing about Google is it's growing faster than any other hyperscaler. It's growing just slightly faster than Azure. We've got growth at around 40%. It'll come in at 30 for this quarter. It'll come in at 39% for the year, we think. But the other good news is AI and data are powering GCP. We've reported on this before, but GCP is closing the gap on AWS in the machine learning and AI space. And the other encouraging thing is its operating margins are now in the low 20s, and we think that's going to continue to increase. AWS has operating margins in, it fluctuates, but anywhere from 35 to 45%, and it's been consistently over 40% last couple of quarters. Azure, I would expect, is there or even higher. So Google is on that trajectory. So exceedingly viable business. Alibaba, has had its ups and downs, but they seem to be back on a growth track. And we've added Oracle to this list, and you can see, look at the jump in Oracle. We're expecting 185% growth rate in their OCI cloud this year. So you got to pay attention to that. Okay, now if you go to the bottom half of the chart, you can see the share shifts. So AWS, losing 5 points just from 2024 to 2025, and that's just within this cohort. You see Azure taking 4 points a share within this cohort of 4. Now, and you go back to 2020, you can see the delta. They're gained, more than 10 points a share. GCP's flat only because you've got Azure growing at the same rate roughly as GCP, and then you got Oracle coming in, and you got Alibaba coming in. So GCP is kind of maintaining its share, and then Alibaba flattish, and then Oracle gains 2 points. It sounds, going from 4.6 billion to 13 billion, you say, wow, that's 185% growth, only gaining 2% share because it's a $275 billion market. So that's the preliminary forecast. We'll finalize that once we get the earnings prints from Alphabet and AWS, or Amazon rather, and Alibaba, which always reports a few weeks after the big three. Okay, so I guess the bottom line for us is we think the street has once again overreacted. We get it, and I think it signals where we are in the AI era and the AI trade, if you will, where these valuations of NVIDIA, the hyperscalers, are, up in the $3-4 trillion range, and people want to see that ROI. We think, as we said, the AI ROI is going to start to become visible in 2026, and we're going to start to see that enterprises are getting a much stronger return, and that's going to kick in. Well, it's going to be a choppy year potentially. We think that we're now entering sort of not quite the middle innings, but the late early innings, and we're going to start to see that, that productivity, and we think Microsoft is definitely going to be a beneficiary. Okay, we're going to leave it there. Thanks to Alex Myerson on production, and he also manages our podcast. Ken Schiffman as well, who's flying solo today. Kristen Martin and Cheryl Knight help get the word out on social media and in our newsletters, and Rob Hof is our EIC over at siliconangle.com. Remember, all these episodes are available as podcasts wherever you listen. Just search Breaking Analysis Podcast. I publish each week on thecuberesearch.com and siliconangle.com. You can email me at david.vellante@siliconangle.com or DM me at dvellante if you want to get in touch, or comment on our LinkedIn post. And check out ETR.ai. They got a new website out. They're awesome and great partners. They get the best survey data in the enterprise tech business. This is Dave Vellante for theCUBE Research Insights powered by ETR. Thanks for watching, everybody, and we'll see you next time on Breaking Analysis.